Good afternoon or good evening, depending on where you're at in the country. Welcome to our Georgia Tech Alumni Association Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone today. I appreciate you taking time out of your schedules to get a chance to spend some time in our workshop today. We're right at the top of the hour. We have a pretty large registration list for tonight's class, so we're going to allow everybody to get into the session. And while we're waiting for everybody to join, just want to kind of, again, welcome you to our class and give you a little bit of logistics for tonight. Our run time for tonight's class is just about an hour, so we should be wrapped up by the top of the hour. This is a very interactive session, so as we get a chance to explore different content around home buying, we'd encourage you to ask questions of us. You can use the chat function in Zoom, or you can use the Q&A function. We'll be kind of monitoring both aspects of Zoom and answering your questions live on air. And then at the latter part of tonight's class, we'll spend some time kind of diving into any other questions that the audience has. So we'd encourage you to ask questions. We'd love to be able to kind of help share back your questions and of course, the answers to those questions with the rest of the audience. Well, again, my name is Jason Maida, and I'm with American Pacific Mortgage. I'm your facilitator for this evening. Really excited to be able to present this content to you. This is what I think our second installment of classes for Georgia Tech this year. I know what's great about the Alumni Association with Georgia Tech is everybody's kind of all across the country, which is really cool for us. And, we're going to explore different kind of housing markets today as part of tonight's class. But as we dive into our class, I'd love to kind of learn a little bit more about where you're joining us from. So if you get a second, just drop in the chat where you're attending tonight's class from. We'd love to be able to kind of learn where you're at, because when we explore housing data, we'd like to be able to kind of share with you what's going on in your local communities. So, as we get ready to go, just want to tell you a little bit more about American Pacific Mortgage. So we're a top 10 lender in the country. Our team in particular specializes in first-time home buying. So we teach classes like this through different partnerships like Georgia Tech to be able to help connect in our local communities to educate you on home ownership. So that is our specialty too. So if you decided to go down that path towards home ownership, we'd love to be able to be a partner for you in this. We are a lending institution, but we kind of start our journey together as part of an educational class. You're going to learn a little bit more about what happens after tonight's class. So if you do want to kind of go through a consultative process with us, we'd love to be able to get connected with you. Just a little bit about me. Obviously, where I work at American Pacific Mortgage. So I'm your presenter and branch manager for American Pacific Mortgage. So I work over multiple states all across the country and get a chance, like I said, to present this content. So, in tonight's class, you're going to have a variety of different talking points that we'll go through. We're going to talk about the housing market, as I mentioned earlier, spend some time looking at what interest rates are doing. I think this is really an opportune time to kind of talk a little bit more about the housing market concerning what's happening with interest rates, and we'll talk about some things happening in the next week. We'll also look at a budgeting exercise, or dive into a budgeting exercise comparing renting versus what it could look like from a buying perspective. We'll talk a little bit about credit, student loans, if those could impact your qualifying. We'll look at loan programs that can help facilitate your financing for your home purchase, some documentation that's generally required. And we'll talk a little bit about savings. How do we save up for home ownership and what that could look like for us, including down payment assistance programs that can be available in your state. And then finally, we'll kind of talk a little bit about the buying process. So after tonight's class, if I'm kind of thinking more about home ownership, and it's a goal of mine in the next year or 2 years, we want to kind of tell you how to get started in the process. All right. Well, those of you that got a chance to drop your location in the chat, really appreciate that. As expected, everybody's kind of all across the country. I see ATL, San Diego, Nashville, New York, DC, Houston. Great. I appreciate everyone kind of sharing that. So that's really cool for us, because it gives us a chance to kind of understand where you're joining us from. Like I said, we're going to talk a little bit about housing market in just a second, and kind of give you some indication on what we're seeing currently and some kind of projections on what the housing market's going to do. Well, as we consider jumping into the housing market, I think it's important to understand a little bit more about, does buying make sense for me? And if this is a financial goal of yours, it's probably going to be one of the biggest goals that you achieve here in the next year or two, whenever that time comes. And I think it's important to think about some of the benefits that come along with owning a home. So let's think about it. Stability of your housing expenses. So, and I don't have to worry about my lease when it renews, increasing that expense there. as you purchase a home, this is an asset. And so that asset hopefully will appreciate over time. And appreciation means that value is going up over time. So the difference between the value of my home in a particular market versus what I owe on my mortgage balance is home equity. And home equity is an opportunity to create wealth. In fact, it can at times create generational wealth for your family. And with homeownership, different than renting, not only do we have the opportunity to create wealth, but potential tax benefits that exist with homeownership. So when we're discovering more about homeownership, I think it's really important to, first of all, kind of dive into a budgeting exercise to do a little bit of analysis of, if I continue down my path of renting, this is what it's going to look like. But if I choose to go down the homeownership path, what are the benefits that are going to make sense for me to jump into this housing market? So let's spend some time for the next few minutes talking a little bit about a rent versus buying calculator. So I'm going to do some screen sharing with this calculator so we can kind of do this kind of what if scenario, if you will. Now, while we're kind of queuing that up, I just want to let everybody know tonight's class is being recorded. So tonight's class will all be shared on YouTube tomorrow morning. We're also going to go ahead and send you all the presentation material from tonight's class as well. So you'll have that in your inbox tomorrow as part of signing up for tonight's class. Well, this rent versus buying calculator is one of the calculators that's available on the Freddie Mac website. So we like to use this as part of our class just to kind of frame up for you what homeownership looks like, comparing that to renting. So let's look at our example. We kind of pre-filled some fields just to kind of keep us on track for tonight's class. And so if we look at an example, and we're going to kind of focus over here where we have monthly rent of $2,000 a month in rent. So we're assuming $2,000 in rent. For a renter, we'll have renter's insurance expense like many of us do today. So we have that set up at $15 a month. And then we expect that as we renew our lease, so as we decide to sign a new lease for our place, that rental increase will go up by 5%. All right. So that's on the rental side of the equation. Then on the home buying side, and this will look different for different parts of the country, but as a baseline number, we're going to use a sales price of $450,000. So if we purchase at $450,000, the minimum down payment generally for a first-time buyer is 3% of that purchase price. And then we have the estimated property taxes for the house. So depending on where you're at, so if you're in Houston, taxes might look a little bit different than, say, taxes in Atlanta or maybe San Diego. But we're going to kind of have a baseline number of $5,000 in taxes annually. We have homeowners insurance costs. We have maintenance costs for the home. So those all go into the side of the home buying piece of things. And then we got to look at our financing that we're going to achieve, right? So we have generally for most first-time buyers, and we're going to talk about this more in just a bit, but it's usually a 30-year fixed mortgage term. So that means those payments are set for the next 30 years. And then we have an average interest rate. So interest rates are kind of fluctuating between 6.0 to 6.25, depending on the day in the market. We have origination costs. So that's what your lender will charge you for your financing. Now, one of the aspects that we have in one of the great benefits as part of our Georgia Tech Alumni Association partnership is that we actually discount our origination costs. So we actually discount them by $750 to try to give you the most competitive financing option for you as you decide to explore home ownership. So that'll be part of your financing package as well too. And then there's discount points that you can pay as a buyer if you're choosing to bring down the cost of your interest rate. Discount points are generally in percentages. So 1% would be equivalent to 1 point in my home financing. And that 1% that I pay will generally reduce my interest rate by about 0.25%. Now, in today's market, I don't necessarily recommend buying down or paying discount points unless we really have to because of qualifying or affordability. And the reason why I say that is because it usually takes about 3 to 4 years to break even on those investments. So I just really wouldn't recommend paying those funds out of pocket. And then we have other settlement services. So depending on what state we're in, it'll be called different terms, but we have title and escrow fees, maybe attorney fees. We have transfer taxes. There's a variety of different expenses that come along with homeownership purchases. And we categorize those under closing costs and prepaid items for your home. I generally recommend buyers budget about 2 to 3% of their purchase price for those expenses. So when we start thinking a little bit more about savings from ownership, we want to consider our down payment plus closing costs and prepaid items. So we're going to learn more about savings and down payment and what that looks like for us, but I want to kind of get us thinking a little bit more about what we got to start setting aside from an asset perspective. And then finally, on the calculator, the last tab we're going to look at is other assumptions. So our assumption is that our home will potentially appreciate about 4% on an annualized basis. We have that we'll expect to be either renting or owning over the next 7 years. We have the selling cost of our home. So we're going to say at the end of 7 years, I'm going to sell this house. So what will that look like? And then we have state and federal tax rates that will obviously vary by the state you're in. And finally, comparing that to a high yield savings rate. So what our calculator does in kind of assimilating this data, we first of all get a monthly payment, right? So our payment's going to jump clearly from a rental perspective, because renting right now, we know we're spending about $2,000 a month in rent. If we jump over to home ownership, now that budget increases by $1,600 a month. That's $3,600 a month. That may or may not work for us. But if it works for us, then we got to look at our total cost opportunity over the 7 years. So what this calculator tells us that is that we decide to buy at that $450 price point versus renting at the $2,000 level, we have about a $51,000 cost opportunity over those 7 years. How we arrive there is taking into consideration the appreciation over the next 7 years versus, the balance that I owe in that house and the tax benefits that come along with owning a home. So, what I always tell future home buyers is, when we think about our budget for home ownership, it's not necessarily an apples to apples comparison, because we really got to factor in all these key ingredients that go into home ownership versus renting. Now, I would encourage you, when you have some time, like I said, you're going to get all this presentation material. If you can, take some time to go ahead and do that calculator yourself. I mean, I do realize all of us in this class have varying budgets, whether it's from a rental perspective or the home ownership levels that we're going to consider buying at. But I think that calculator is a really useful tool for you. Now, let's talk a little bit about the housing market. Now, I know we're all across the country in tonight's class, and that's great. What's interesting, when we look at national housing data, it looks very similar for most markets. So if we were to pull a snapshot for Atlanta or Texas or California or New York, trends look very similar in the market. Now, let me tell you what we're seeing going in the market in our world. Traditionally, April and May, when we have our warmer months in the housing market, we start to see buyer activity start to pick up. It gets a little nicer outside. People are out in their cars, driving around on a weekend. Well, this market has been a little bit different in 2024. And the reason why is we've seen this kind of the buyer demand kind of push out all the way to July and August. So we really didn't see any activity into July and August. Most notably, we're seeing that because buyers were trying to figure out where interest rates are going. And we're going to talk about interest rates in just a second, but I think the average consumer has come to the realization that while rates are starting to trend lower, it's not going to be dramatically lower, especially we're not going back to the rate levels that we saw in, during the pandemic years. So certainly, these rate levels are probably here for the next year or 2 years. So you're starting to see buyer demand start to pick up. Now, the challenge that we have in the market is there is not enough inventory to help support buyers in today's market. So hopefully, as rates start to trend down, we'll see more sellers that are bringing their homes to market, will help the resale market. And then we need to see more builders obviously create more home opportunities for buyers as well. But you can see kind of this pattern of, a little bit of a downward pressure on prices here nationally. But what our thought is that we'll probably see this level out, and which we're going to talk about interest rates in just a second, we probably will see prices start to go upwards, because as interest rates start to decline, buyer demand picks up. And if we don't solve for inventory levels across the country, then we'll see that demand pressure kind of really impact those prices. Now, we have some great trends from an interest rate perspective. Then this chart kind of highlights that. Over the last 4 weeks, we've seen interest rates decline. In fact, we're at the same levels we saw in February of 2023. So a really encouraging sign there. Rates tapped out at about 8% back in October of 23. That's where we saw historical levels. Actually, it's 20-year highs back in October, but we're getting back down further and further, which is helping buying power for first-time buyers. As I mentioned earlier, it's also creating a little bit more buyer demand pressure. So that's good news. Maybe not necessarily from a pricing perspective, but certainly more people are coming back to the market, and hopefully that'll bring more sellers back to the market. Now, I think it's important to understand, how do we get here with this elevated interest rate market? It's no longer the 2s and 3% interest rate. Well, the Federal Reserve has been trying to control inflation. You know, when you and I go to the grocery store or fueling our cars, whatever the case may be, things are more expensive. Housing is the biggest segment of that, which housing is the affordability levels are just not in line right now. Well, the Federal Reserve has tried to escalate the federal funds rate to control inflation. And we've seen inflation in better levels. You know, in fact, the inflation readings we got this week are still continuing to move lower. I think it's the lowest levels we've had in the last 2 years. The inflation goals for the Federal Reserve is 2%. We're not quite there yet, but it looks like with the pending Federal Reserve meeting next Wednesday that we will probably see our first rate cut, which rates will probably be cut. We're estimating about 0.25%, possibly 0.5%. So it remains to be seen kind of what happens there. But the challenge right now we're seeing in the economy is the labor markets. There seems to be some stalling in the labor markets. We had revised employment numbers come out a week ago. I think it was a difference of like 800,000 jobs. So, you know, there is some concern about a slowdown in the economy. And so, you know, you're going to see the Federal Reserve take action next week with some type of rate cut. We just don't know what that looks like. It's either going to be 0.25% or less likely 0.5%, but it'll probably be the 0.25%. Now, I think it's important to understand as a consumer, you're going to hear a bunch of different things from news outlets saying rates have dropped by 0.25%. Well, if you're considering home buying, that doesn't mean that rates are going to drop for mortgages 0.25%. It's not a one-to-one ratio type of thing, but it will spill over into interest rates. And we're already seeing signs of the decline in anticipation of that rate cut. Where you will see the direct correlation is things like borrowing costs for credit cards, personal loans, lines of credit, if you decide to go buy a car, which I don't recommend that if you're going to go buy a house first, but all those financing vehicles you will see drop in correlation with the Federal Reserve reduction. Now, interest rates for mortgages are not the same for all clients, and I think that's really important to understand. So even though my coworker or my family member got this particular interest rate, the timing in the market may dictate when they got that interest rate. So if someone's saying, hey, I got a 3% rate back in 2022, well, that's not as relevant as it is today. But even in today's market, there's certain characteristics that go into interest rate, like the credit eligibility levels, how much you decide to finance, what type of product that you're going to elect, how much is your down payment, do you decide to pay additional out-of-pockets like points like we reviewed earlier, or what's the term of my loan look like? Most first-time buyers are going to elect a 30-year fixed mortgage term. That means my loan term is fixed for the next 30 years. But in normalized markets, if you condense that term down to say 20 years or maybe even say 15 years, that'll generally bring down the interest rate. However, we have an inverted yield curve right now with short-term and long-term rates. So we don't really see a benefit of a shorter term right now with a lower interest rate level just because of where short and long-term rates are at. All right, so that kind of gives us an idea of the housing market, interest rates, and of course, we talked a little bit about our budgeting. Let's talk a little bit about credit. And I think as I meet with clients across the country on credit or in really building their home buying plans, there's like two concerns that generally will come out of those conversations. One is maybe I just don't have enough saved right now for home ownership, and it's going to be maybe a 2 or 3 year goal for myself. And we're going to explore resources around that. But the other challenge can be credit. Maybe I'm overextended. Maybe I've had some historical challenges with credit. So what we like to do in our classes is just to kind of give you some more tools and resources around credit. And I think it's important to understand that every loan product has a varying credit score minimum. So you can see some of those on screen with our different products that we'll explore in just a few minutes. But there's also different scorecards for credit scores. So there's actually 3 different scorecards. There's a credit card model, there's an auto financing model, and then there's a mortgage model. So many of you that are using monitoring services like Credit Karma, or maybe you're using some tools through Amex or Wells Fargo or whatever banking institution you use, they're generally going to use a credit card model. Now, if you go to apply for home financing, of course, we're going to use the mortgage model. And so I think it's important to understand what that model might look like for you. So let's take a look at this weighting here. So 15% of the FICO score is going to be how long have I had credit? So the more mature my credit file is, the better my credit score should be. 20% is going to be how much new credit am I trying to activate? Am I trying to bring new accounts online to my credit report? Am I applying for new credit? And those new credit inquiries would be hard inquiries that are impacting my score. So that would have a 20% impact to the overall score. Now, one of the things I just want to point out to you is as you get a chance to work with our team to design your own home buying plan, we only start with a soft inquiry. Our logic behind that is many of our first-time buyers, especially, are not probably going to buy this year. It might not even be next year. So we don't want to impact their score immediately. We want to help build a home buying plan for them without having that impact to the 20% weighting of the score. Now, 30% is going to be credit utilization. So we're looking at credit balances that we have outstanding versus our credit limits. So that's called credit utilization. It's simply a percentage of my credit limits that I'm accessing right now. Now, when you look at those revolving accounts, credit cards, personal lines of credit, things of that nature, that percentage, we want to manage that down as best possible to at least 10%. Well, I shouldn't say at least, optimally at 10% or less of those credit limits. If you're running at maybe an 80 or 90% utilization, my first kind of target number would be at least 50% utilization to help improve my credit score. And so if you take some time to look at some of your outstanding credit card debts, look at one of your credit card statements. There should be 2 dates on that account, and one is your billing cycle or statement date. The other date is your due date. And here's kind of a tip I want to give you for tonight's class. If you look at that statement or cycle date, that is the end date that all of your activity for that billing cycle is closed out on. It's also the same date that the credit card issuer is going to send out your payment information to the agencies. Now, we all know the 3 agencies. There's TransUnion, Experian, and Equifax, right? So that's when they report that data out to those agencies. So my tip for our audience tonight is that if you can pay down those balances before the end of the cycle close date, what you're going to do is you're going to bring down that balance, hopefully lower your utilization, and then give yourself a much more improved credit score, especially if you're getting ready to apply for major things like a home, obviously, or auto financing. The lower you can get that utilization, generally, that's going to give you a much more improved credit score. The last component to the credit model for mortgage is going to be payment history. And that's part of the model for all risk scorecards. But ultimately, we're looking at past credit history. If there are late payments there, they're rated as 30-day lates, 60-day lates, and then 90+ delinquencies. So the higher on the spectrum of late payments, the bigger impact it's going to have on the credit score. Now, usually events in the last 12 to 24 months on your report are going to have the biggest impact to your score. As you move further away from that event, so let's say once I get beyond 24 months from the event, then I'm going to see my score hopefully organically improve from that point. Other events like bankruptcies, maybe short sales, foreclosures, those are obviously more significant. Those are going to have a bigger impact to your credit score. So, those are things they may take a little bit more time from a seasoning perspective to see some kind of rebound on your credit score. Now, in lending, we always look at all 3 agencies' credit scores. So we're going to look at Experian, Equifax, and TransUnion, but we always take the middle score of all 3 reports. So let's say as a borrower, I'm at 760 is my highest score, 740 is my middle score, and then 720 is my lowest score. Well, as a baseline qualifying number, 740 is the score that we'll use in qualifying for that client. Now, if I have a partner that's going to join my application and my partner wants to apply with me jointly, we're going to look at the lowest credit score between both borrowers. So let's say that my partner is at 700, 680, and then 660. Well, 680 is the lowest middle score between the 2 of us. So that's the score that would be used for qualifying purposes. And that's really important to understand because it's not just qualifying, but it also could impact your interest rate, the cost of mortgage insurance, as well as the program that you're going to select. And so, I think, there's some strategy around that when we meet with you for a consultation to see how we can optimize your credit score and do some assessment to see what maybe the next level of credit score is to help improve and really bring down the cost of your overall financing. So if you're at a 740 credit score, maybe there's an opportunity to get to 780 and that lowers your interest rate or the cost of your mortgage insurance. There may be really simple action steps that we can do to help improve that credit score. Last thing I want to touch on this screen is just account closure, which is pretty simple, but you want to be careful closing out revolving accounts, especially long-standing accounts that you've had for multiple years. Because if you decide to switch to another credit card issuer and close out that old account, it can do 2 things to your credit report. One is it takes away all the history from the dates that you've had with that credit card issuer out of the credit agency's model. So if I've had an account for 7 years, I close it out, 7 years gets completely taken out of the model, and it hurts me from a length of credit perspective. It also takes away another available credit line that I have in my utilization. So, you just want to be mindful of what you're doing when you close out accounts, because you could have a negative effect on your score, even if you're just trying to limit the temptation of a credit card, or just maybe you're just not happy with the service levels of that credit card issuer. Just be careful before you close out that account, before before that creates any type of negative impact to your score. All right, now this is a matrix that can show you how long negative items will stay with your score. And so hardened credit inquiries, they'll be on there for 2 years, but I would say hard inquiries will hurt you in the most recent 6 to 12 months from the inquiry. Now there are rules in most states for hard inquiries, and that is if you're applying for auto financing or mortgage financing, there's a 30-day rule in place, which basically means is that when I go to apply with one of those companies on day one, I have a 30-day window of time to shop around with as many lenders as I want to, and that's the equivalent of 1 credit inquiry hit to your score. Now, other items that are going to stay on your credit report, like late payments, will be on there for at least 7 years. When you have public records, a little bit longer, closer to 10 years. But the impact to the score is usually in the most recent, I would say 12 to 24 months. All right, before we dive into student loans, any questions so far? I know I've covered a lot of content up to this point, but I want to make sure that I answer any questions from our audience. Anything that comes up from our group, if you do have any questions, you can use the chat function or you can use the Q&A function in Zoom. All right, I know we had some late arrivals to tonight's class, which is totally fine. I know we're in different time zones. So if you do have questions, like I said, it's a very interactive session, but we'll also carve out some time in the latter part of our class. Let's talk a little bit about student loans. And I know, some of us may already have student loan forgiveness, which is great, but you also might be in forbearance or deferment for student loans. If you have forbearance or deferment or active repayment, we do have to count that monthly payment in qualifying for your financing. So if you're in forbearance because of maybe payment arrangements or deferment because maybe you're back in school, regardless of the scenario, we still have to count a minimum payment in qualifying. So let's say I have $75,000 in student loan debt. If I'm applying for a conventional loan, I usually need to count 1% of the balances. So in that case would be $750 in total monthly payments. If I'm in deferment or forbearance, if I'm doing an FHA loan, it's usually half of that amount, $375. So really important to understand that, because that calculation could impact eligibility. And so regardless if there's a 0 payment showing on your credit report and you're in that forbearance or deferment, we still have to count a minimum payment. Now, if you're in income-based repayment and maybe you're paying a lesser amount, hopefully you are, then whatever that income-based repayment amount is, that's what we use for qualifying purposes. And we'll walk through all this stuff with you as part of a consultation with you, but I think it's helpful to understand, especially as those that are, experiencing repayment of student loan debt, to how that could impact you from an eligibility perspective. All right, so question in the Q&A came in, and we're going to talk a little bit about loan programs, which is when will we start to see prices go back up as interest rates come down? And it's like kind of more of a purely speculative question. So it's really kind of an unknown timeline on when we're going to see prices go up. I think the major component to that is, what do inventories levels look like? And really, are we going to have resellers get homes back in the market? So really, if someone that's an existing homeowner, are they putting their home on the market to create more inventory? And are builders building new homes? And so I think that's really the question mark, because I think there's no doubt that as interest rates go down, the buyer demand is going to pick up, but we just don't know what inventory looks like to support those buyers. So I will say, from my perspective, because obviously I work all across the country and we've been helping clients for years, and so we have a lot of first-time buyers that are now graduating into their second home, right? And I will say, with the recent decline in interest rates, we're seeing more and more of them saying, hey, Jason, I think I'm ready for that next house. Maybe I bought a condo and now I'm ready to buy a single family home, right? Or maybe I really want my kids to be a part of this school district, so I'm ready to move. And so I think more and more of those conversations are going to start happening across the country for current owners. because I think while we're not at the rate levels of 3 and 4% that maybe everybody would love to have, I think it's still, there's enough of a downturn that existing homeowners are saying, I think I want to look at my options. Okay. All right, great question. Let's talk about loan programs, speaking of options. So I want to just spotlight these 5 programs. I'm going to give you kind of a high level look at each of these. You've probably heard of these different types of programs, but I just want to give you a better understanding of it. So the first program is conventional loans, which will be under Fannie Mae and Freddie Mac. You may have heard about Fannie Mae and Freddie Mac, especially in 2008 with the housing crisis. But they account for about 70% of all originations across the country. There are different loan levels for Fannie Mae and Freddie Mac. The number one limit is the conforming loan limit, which goes up to 766,550 all across the nation. Now, in certain areas, like I know we have one of our classmates is joining us from San Diego, like down there, we can go into the $1 million loan range. The difference is that's called a high balance loan limit. It does require a buyer to put down a minimum of 5% anytime we go beyond 766,550 as a first-time buyer. So if I'm looking in a lesser cost area, then the down payment is 3% up to that 766,550 amount. The minimum credit score for a conventional loan is usually 620, and so that's kind of the minimum cutoff for that product. The next product is the FHA loan. It stands for the Federal Housing Administration. That's a government insured loan, minimum down payment of 3.5%. The loan limits for FHA vary a little bit differently than the conventional loan. So it'll usually be based upon the county that you're in. So we kind of just have as a baseline here 766,550, which is the conforming limit, but it will vary based upon what part of the country you're in. This is a government insured loan, and we're going to talk more about mortgage insurance and how that relates to this product in just a bit. The FHA loan has a minimum score of 580. What you'll find with the FHA product as compared to a conventional loan, a lot more flexibility from an underwriting perspective, whether that's, maybe past credit challenges, or maybe that might be expenses that are a little bit higher for a buyer in the FHA space, but it is government insured, so it's a little bit more flexible. The next product is the VA home loan. That's for our veterans that have served. That's just an amazing product that's going to allow even more flexibility for the veteran to enter home ownership, whether that's, higher expenses for the veteran that can, maybe we can help get through underwriting a little bit easier, lower interest rate options for the veteran, just to make the access to home ownership that much better for them. It is a 0 down payment option. There are what we call VA funding fees as part of that product. If our veteran has any type of partial disability, generally that VA funding fee is completely waived. And with the VA product, usually it's a minimum credit score of 620. And finally, with the VA product, there is no maximum loan amount. So for our veterans that are purchasing in higher cost of living areas, we can go $1 million plus in loan amount with that product. And then the last 2 products I want to spotlight is one, the USDA product, which is for buyers that want to purchase in more rural areas. This product looks very similar to to an FHA product. There are 2 forms of guarantee fees to the USDA. There's an upfront guarantee fee and a monthly guarantee fee. And there's also 2 major qualifiers there. They have income limits based upon where you're going to buy, and it's the household size. And the property has to be located in a USDA deemed rural area. And then finally, there's a jumbo loan, and those are for clients that need a little bit more financing resources. Maybe they're buying a million or $1.5 million property, but it does have a trade-off of higher down payment and higher asset requirements called reserves. Those reserves generally need to be upwards of 12 months of the equivalent mortgage payment. So, if I have a mortgage payment of, let's say, $8,000 a month, I would need an additional $96,000 in asset accounts. Okay, not really typical for a jumbo loan for first-time buyers sometimes, but not often. Let's talk a little bit about mortgage insurance. There's different forms of mortgage insurance. There's PMI, which is private mortgage insurance, and there's government insured loans, which would be under the FHA product. Now, the question we get often is, what is mortgage insurance? It's not homeowners insurance, which insures my house. It's actually insurance that insures the lender against default by the buyer. And so if we look a little closer at PMI, the private mortgage insurance, we have about 7 to 8 different private mortgage insurance companies that we partner with under the conventional loan. And conventional loans have various payment options in how you pay back the mortgage insurance. There's monthly payment options. You can do what we call as a split mortgage insurance, and you pay some of it up front, some of it on a monthly basis. You can completely buy out the mortgage insurance with a single premium amount. And there's also lender paid mortgage insurance, where you basically take a higher or elevated interest rate in order to buy out the mortgage insurance. Now, if you've started your home search on Redfin and Zillow already, or just any type of website, they probably have some payment calculators there. What I would just be aware of is most of those payment calculators are not totally accurate from a mortgage insurance perspective. And the reason why is because there's a calibration to mortgage insurance. It includes credit score, down payment, and amount finance. So that those premiums can vary based upon that criteria. So if we take a look at the mortgage insurance example for a conventional loan, let's say I'm borrowing $450,000 and I'm putting 3% down. I have say a 740 credit score. My mortgage insurance is about $183 a month. Okay. So somewhat reasonable. And certainly if I can elevate my credit score or maybe elevate my down payment, that mortgage insurance cost will come down. Now, on a conventional loan, there is a cancellation option for mortgage insurance, which is once I have 2 years in my loan and 20 to 22% equity, I can apply to have that mortgage insurance canceled. Now, on the other side of the ledger is the FHA product. So it is government insured, but it also has two forms of mortgage insurance. There's monthly mortgage insurance, which is 0.55% of my total loan amount. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. So that 1.75 gets added on to my total amount finance. Different from the conventional loan, FHA loan does not have a cancellation option. So generally, we're going to use the FHA loan as, I would say, a temporary solution for some of our buyers. So if we have some credit challenges, or maybe it's just maybe a better fit overall, we can use the FHA to access homeownership. And then hopefully, as my clients' credit's improving, or maybe the asset situation looks a little bit better, we can transition into more of a conventional type product. So if we look at FHA on the mortgage insurance side and finance the same amount of $450,000. The upfront mortgage insurance is $78.75, so that gets tacked on to the total amount financed. And then we have a monthly amount of $206, which is going to be slightly higher than the conventional premium of $183 per month. So clearly you can see the variation here of difference in cost. And I think it's important to understand that, as we work with you, we're going to figure out the best product match for you. And because, most of our buyers will want to get to the conventional product, but we have to figure out what the right product match is based upon qualifying and your overall home ownership goals. All right, so let's spend some time talking a little bit now about income. So I like to kind of just go in this part of the class just to kind of give you some different scenarios to think about, because it might be applicable to you as a future first-time home buyer. And before I do that, I just want to give you a quick document checklist. So if you're thinking about getting on this path towards homeownership and you're wondering what are some of the documents I would generally need? Well, we usually need the last 2 years of W-2s, last 30 to 60 days of pay stubs, and usually the last 2 months of bank statements. Okay. Now, in verifying your income sources as say a W-2 wage earner, we generally need to verify the last 2 years of work and or educational history. So we can combine those together. So for example, if I graduated from Georgia Tech in the spring and I just started my job here over the course of the summer, I had 4 years at Georgia Tech and maybe I just started my job a couple months ago, that technically qualifies for that 2-year requirement. So we just have to build a 2-year employment or educational history for you to qualify for a mortgage. So a lot of misconception out there that you have to have 2 years on your job, which is just not absolutely the case at all. Now, if you're transitioning jobs, so let's say I'm currently employed at a 40-hour workweek job, but I have an opportunity to start somewhere else, right? If you have an executed offer letter, we can use that offer letter to actually qualify for your mortgage. And then depending on what your start date looks like, that'll determine when you can actually start actively going out and looking at homes. Now, the 2-year rule gets a little bit more, I guess, tricky, if you will, when it comes to self-employed individuals. So if you're self-employed, where you have your own business or you're an independent contractor, we do have to show that you've had 2 years of tax filings in order to use your self-employment income. So that's where it differs a little bit. Also, if you have multiple sources of income, so let's say I work for 2 employers, maybe one for 30 hours a week, the other for 20 hours a week. In that case, in order to demonstrate that I can handle both jobs, I do have to show that I've been on both jobs for 2 years simultaneously. And if you do have additional income, so let's say I have a full-time job, but I also work for Uber on the side as an independent contractor, you can include that income, but you do have to show that you've been doing both jobs for 2 years. And Uber or Lyft or Uber Eats income, all that stuff, that's going to fall under Schedule C, sole proprietor income. So generally, we do an average of that income over the last 2 years. Last thing I want to touch on income is just other sources of income. Like, let's say I have a partner that contributes to my household income. That's totally great. However, that income stream cannot get factored into qualifying for financing unless that person is going to join you on your application. Even if you have room rents that you're gathering right now, we see that often. Some programs will allow you to use those room rents for qualifying purposes, but most often it cannot be used. Now, when we look at and assess income for buyers, we do an expense to income ratio analysis. We call that debt to income ratio. It's a really simple calculation. We're looking at pre-tax monthly income versus monthly expenses. And it's not all of your expenses. We're looking primarily at what's going to show on your credit report. So things like maybe credit card expense, personal loans, student loans, auto financing. And we also want to take into consideration what your new housing expense is going to look like for your home mortgage. Generally speaking, we don't want our expenses to exceed more than 43 to 45% of that pre-tax income. Okay. Now, at times, we can stretch as far as 50% of debt to income ratio, so 50% of our income. But, obviously, we want to be cautious there and make sure that we're not putting our clients into a difficult financing situation. Here's what the calculation looks like. We're taking in consideration principal and interest, taxes and insurance for the new mortgage. We have PMI, so if we're putting less than 20% down, that gets factored in. For buying a condo, maybe a townhouse, homeowners association expenses. And then we add in the additional expenses like car payments, personal loans, student loans, and then we divide that by our pre-tax income. So in the scenario you have on screen, you can see our client has $3,000 in expenses, $8,500 in income. So our debt to income ratio is 35.29%. So that would be in the space that I would call maybe more comfort zone for our clients, which is usually about 33 to 36%. That's where I see most first-time buyers feeling pretty good. But let's understand that affordability is a challenge for a lot of us in most markets. So that debt to income ratio at times may creep up closer to 40 to 45%. And those are things that we'll talk through as part of your consultation plan for home ownership. Now, the two big goals we have for you in homeownership is going to be affordability. So that's a conversation we're going to have, like, what's an affordable budget for you? And we also have a sustainable goal because we want to make sure that over time, as things are changing for you financially, that homeownership still works. And so that's why that home buyer consultation is so important to design the right plan for you. Well, the last thing we wanted to cover in building a plan for you as part of our class is to talk a little bit about savings for homeownership. As I mentioned in our lead off to tonight's class, is that's kind of the second challenge for some home buyers. It could be credit, but it could be also around savings. So I want to share with you what's typically the documentation for that. And then I also want to give you an actionable item today. So generally, in terms of savings, we want to save up in our checking and savings accounts. We're going to provide proof there. Sometimes we can use 401ks, 403bs if that works with your plan administration. I would encourage you, though, talk to your financial or tax advisor before you access those assets. And then gift funds can also be used. And so that's where you have a family member that's contributing to the purchase. Gift funds do not need to be seasoned at all, but they do have to be paper trailed. So assets generally in home buying need to be seasoned at least 60 days, but in gift fund scenarios, they do not need to be seasoned. So let's talk a little bit about savings. And so, that's a challenge for most of us, especially if we're just getting started financially. And we totally understand that. We're going to have to think about savings for down payment, as well as closing costs and prepaid items to purchase a home. We're going to spotlight some assistance options as well. But let's just give you a simple actionable item to start today when it comes to savings. So as we kind of build a home buying scenario, let's say we're currently renting at $2,000 a month in rent, right? But after meeting together, we feel like we can afford on a monthly basis $3,000 for my new housing expense as a home buyer. So right now we have a $1,000 variance between those two numbers. So if we're not quite there from a savings perspective, what I would encourage the buyer to do is let's set a savings goal by essentially taking that $1,000 variance that we know we can afford above and beyond our rent payment. And now let's start deploying that to our savings account on a monthly basis. So now we're essentially kind of basically creating a discipline for ourselves that we're actually paying $3,000 in housing, but instead of giving that landlord that additional 1,000, it's going to our savings account. Maybe it's a high yield savings account. Over time, we've created that discipline of essentially having $3,000 outgo every month, but now we've stacked up $1,000 each month in the savings account. So by the end of 6 months, we got $6,000. End of the year, we have $12,000, not including potentially interest there. So I think that's a real simple but effective approach to start building savings and creating the discipline of paying that higher expense, because undoubtedly with homeownership, you're probably going to have to take the leap of going up just a bit when it comes to your housing expense in order to, achieve really what you're looking for from a homeownership goal perspective. All right, so that's our savings plan. And to help you get on the path to homeownership a little bit quicker, there are various first-time buyer programs available. Now, there are national programs through Freddie Mac, like the Borrow Smart program. It's going to provide some options for you to get some additional support for down payment and closing costs. It's not a significant amount, $500 to $1,500, but it generally will help moderate to low-income households. In Georgia, I know we have a few of us that are in Atlanta. There is the Dream Homeownership Program in the state of Georgia for affordable housing on low to moderate income households, up to $10,000 to $15,000 that could be used towards low to moderate income households. If you're in California, California has an agency called Cal HFA, the California Housing Finance Agency. There's a variety of different programs like the My Home Assistance Program. It'll provide up to 3% of your sales price in assistance. I know there's some of you for DC, we have Virginia represented, Texas. All those states have a variety of different housing agencies. Of course, in tonight's class, we won't have time to cover all of those agency products, but I would encourage you to get connected with us after tonight's call, especially when we do a consultation. Depending on where you're going to want to buy, we'll explore what first-time buyer options can look like for you. All right, let's spend some time talking about the buying process. So, after tonight's class, you may be encouraged, hopefully, and you may think, hey, you know what? This is a goal that I want to have for myself financially. So I want to kind of help you understand, like, what's the path going to look like for you? Now, I would say the first step after tonight's class, if you want to design a home buying plan, is to get connected with us for a consultation, which you're going to learn a little bit more about. That's a one-on-one session with me for a 30-minute video session for you. There's no obligation. That's a free service we provide to our partners across the country. But I just want to kind of let you know that would be the next step after tonight's class. And then from that point going forward, we would issue what we call as a pre-approval. And the pre-approval shows the design of your financing, what your interest rate looks like, your sales price, your amount financed, and really gives you a full design. So if you do want to take the next steps and really start looking for homes, you know what the framework should look like for your budget. Now, that pre-approval is good for 60 days, but it can be recertified at any time. So if you're not going to buy this year, that's still okay. We can always recertify that for 2025 as a goal, or maybe even 2026. But we want to create a baseline for you with home ownership. So step 2 is the house hunting. That we would generally encourage you to connect with the local realtor to be able to help kind of show you different options in the market. In fact, we have some alumni that are actually working with us as preferred realtors in the Atlanta market and other markets across the country. So we'd encourage you to get connected with either one of our preferred realtors or a realtor on your own. Now, there are changes in some of the commission laws that realtors incur now today. Now, I'm not an expert on those, but over the last 2 weeks, the settlement of the NAR, National Association of Realtors lawsuit, is now kind of like in play now, where commissions have changed as how buyers agents get paid for in your representation. So, it was kind of, in the past, it was always assumed that sellers would pay the commissions of buyers agents. That's not necessarily the case now, so that has changed. So there are buyer agreements that are put together with both the buyer and the buyer's agent that's represented. So I would encourage you, when you do interview and select a realtor, to have that conversation. So, those changes, like I said, have come down in the last couple of weeks. Now, once you've selected a realtor and you're doing your home shopping, and let's say you find a home that you love, you present an offer to the seller. Now, you may have some negotiations that go back and forth, but let's say you settle on a price and now that agreement is ratified. Well, then we're going to move to step 3, and that's called entering escrow. So that means you have an agreement with the seller, and it opens up the escrow time period. In most states, that escrow time period is 30 days. So if I'm at day 1 today, so we're at September 12th, so I would close escrow on October 12th. So that's the date I would become the official owner of the home. Now, once we have that ratified contract, there's a few things that happen. One is you get a call from our team saying, congratulations. We're really excited to help support you on the journey, but we're going to talk a little bit about timelines in your contract, state of the market, and then kind of talk to you about your action items list for you as a home buyer and schedule you for a follow-up video session so we can kind of reaffirm all the details of your financing. Now, as a home buyer, it's also going to have action items for contributions of what we call a deposit for you in most states. It's called an earnest money deposit. It's usually 1 to 2% of your sales price. It will count towards your total out-of-pocket expense, but it's kind of your initial investment into the home purchase. Now, most states have what we call contingency periods as part of their purchase contract. It allows you as a buyer to essentially do your investigative or homework on the property, which will include getting the house appraised to ensure the house is worth what you're buying it for, getting your house inspected to make sure everything aligns properly. There's no, dry rot or cracked foundation, whatever the case may be. And finally, we want to get your loan approved. And that's obviously something that our team will handle for you. Most often, those contingency periods are anywhere between 10 to 17 days in the contract period. So if I have a 30-day escrow time period, usually in my first 10 to 17 days of the contract, I can do all my due diligence for the property. Now, step 4 is going to be more of the administrative tasks that us as a lender will complete for you. That's the processing of the loan, including verifying employment, accessing credit, verifying assets. We will be looking to lock in your interest rate sometime within that escrow time period. We've talked a little bit about interest rates today, so there's a little bit of a strategy around when the right time is to lock in your interest rate. So just because you enter escrow on day 1 doesn't necessarily mean we have to lock in the interest rate on that day, especially with pending changes in the market. We want to be really strategic on how we lock that interest rate. Step 5 is going to be loan approval, and that's when we have an underwriter that has issued the approval of your financing. And at step 5, we're almost about 3/4 of the way through the process. And so by that time, we've received your appraisal back on the house to support the purchase price of the home. We've got all kind of the administrative tasks completed. And at that stage, we also are probably at the end of your contingency period. So if everything looks good from a financing perspective, appraisal looks good, and you feel good about the inspection reports you've done, then you can sign off on your contingency to the seller. That tells the seller that you're ready to go to the final stages of closing. It also triggers us to issue your final closing disclosure, which essentially gives you a 3-day cooling off period before we go to the final stage called closing your loan. And closing your loan from a financing perspective is the in-person part of the process. Everything up to that stage can be all done via e-signature disclosure, but at step 6, you do sign documents in person with a public notary or maybe even an attorney or escrow officer, depending on the state you're in. That takes about an hour or so. And then after that is completed, you'll generally wire in your final funds for closing. Us as a lender will also wire in funds, usually the next day, or depending on what state, could be the same day. Those documents that you've signed now are recordable documents that get recorded with the local county recorder's office. There's usually a grant deed, which transfers ownership, and then the deed for the loan that we're securing gets recorded as well. And so confirmations come back to all the parties involved. And once we get notification of that, then the big celebration happens. Now you become the official owner of the home. That's an awesome day because we get a chance to celebrate with you. And, I get a chance to at least make those calls 2 or 3 times a day. It's the best part of my day because it's obviously a huge celebration for you. Many of those clients that we make those celebration calls for have started off in classes just like this, which is really cool because they've looked at classes, they've kind of done their homework, they've built their consultation, gone on that path towards homeownership, and now become homeowners. So it's a really cool thing to celebrate. And if you're thinking about getting started on the path to homeownership, doesn't necessarily have to be a 2024 goal, could be 2 or 3 years down the road. We love to be able to be a partner for you in that. And it's a real simple start process. It's a 3-step process. There's a really simple online application. We only do a soft credit check. You upload proof of things like income and assets to our portal, and then we schedule a video consultation with you through our scheduling system. Really simple process. And we want to make it easier for you because we understand there's a lot of things going on. This is a big, major financial decision. So we want to make sure you have a really simple, streamlined process for you. This is a free service that we provide to our partners in our communities. And it looks a little bit like this. So we're going to kind of better understand, where do I want to buy? What price point am I looking at? What are the interest rates that I'm looking at for particular loan programs? Do any assistance programs apply to me? And just build a comprehensive plan for you. So when you decide to take those next steps, you know exactly what everything looks like for you with home buying. Now, as we get to the end of tonight's class, we have some really great resources that are available to you, like our mobile app. We'd encourage you to download. That's available through iPhone and Android. You can do things like start your application process. You can follow milestones of your loan. And probably the most popular things used by most of our buyers is our calculator. So as I'm looking online or out looking shopping for homes, I can run calculations, accurate calculations through our mobile tool. So as we come to conclusion tonight, again, we're super proud of our Georgia Tech partnership. Something we've actually extended on for multiple years, and really excited to see a great attendance for tonight's class. We also have other partnerships across the country that I want you to make you aware of. And our classes are always open to the public. So if you have friends, family, maybe some colleagues that might enjoy a class like this, we'd encourage them to kind of check out some of the upcoming classes. We still have many classes left on the calendar for 2024. We generally teach about 60 classes a year, and we'll have more on 2025's calendar, but there are still some dates left for 2024. Here's all my contact information. So as we wrap tonight, I just want to make sure that you know how to get a hold of me, whether that's to schedule a consultation or just kind of ask me some questions. We want to make sure that we're available to you. And as I mentioned, our class is recorded. It'll be up on YouTube tomorrow. You can locate our YouTube channel at JMATA Mortgage, so JMATA Mortgage. That's also our social channel for Instagram. You can find all kind of our updates. We try to post resources that are helpful for you on this journey, so feel free to come check us out on like Instagram. All right, so we're just almost to the top of the hour, but I'm getting some questions in the chat and Q&A. So I'm going to answer those questions, and we'll stick around here as long as we need to make sure we get all the questions answered. So first question was, how different is the process how different is the process for people buying without a loan? Okay, so that's a good problem to have. So if you don't need financing, let's say you're paying cash for a home, obviously you'll strip away the loan process side of things. It depends on timelines that you set with the seller, but I would imagine that process probably could be as quick as 7 days. But it just depends on what the negotiations look like with a seller. But, it would look fairly similar. You would have disclosures from the escrow company that you would complete. You would still disperse funds for the home purchase, but I mean, you'd probably shrink that 6-step process down to maybe 3 or 4 steps. All right, nice question. I don't get that question often, but thank you for the question. All right, and okay, so can't answer that question. Okay, cool. I've got that one too. I will just one of the questions came in the chat, which is PMI. So just to clarify for everybody, there's PMI and there's MIP. So there's the PMI is private mortgage insurance, and then the MIP is the mortgage insurance premium. That is on the FHA side of the ledger, which I said, that's a government insured type of insurance product. Okay. All right. I think we've, okay. Okay, so I'm going to go back. We had somebody that attended a little bit late, so they want to kind of just do a quick recap on points. So points are when you're electing to pay additional expenses out of pocket to bring down your interest rate. Usually a point is 1% of your loan amount. So if I'm financing $400,000, means I'm willing to pay $4,000 in order to bring down my interest rate. Now, that 1 point usually equates to about a 0.25% reduction in rate. As I mentioned to the class earlier, I'm not a huge fan of buying points right now because it's about a 3 to 4 year break even. Most clients that are buying in today's market are probably going to refinance in a couple years. So that doesn't necessarily give us a good return on investment. And then question was, can you speak a little bit about buying a home with friends? Okay, so you can certainly purchase with friends or family, depends on what the occupancy ultimately looks like with that. If everybody's going to occupy the property, that's totally fine. You can all be owned as a primary residence. The different products could change. I mean, if you're looking at first-time buyer eligibility, just depends on if all parties are first-time buyers and the specific first-time buyer program we're looking at, but you can certainly do that. One question I get too often is, to purchase as joint owners, do we have to be married? That question comes up, and that's not the case at all. You can be in a domestic partnership. No partnership at all. You can buy as joint owners. That's absolutely okay. And then, are there any programs for someone in law enforcement who is a first-time home buyer? So we do have a discount in in cost for our first responders. Some states will have specific assistance programs. So just let us know where you're thinking about buying, and then we can talk through what options look like out there. But it can be, absolutely. How can we get the question was, how can you get the calculator? We mentioned Ken will drop that in the chat for everybody. We can also have that distributed in well, it's going to be part of the presentation material that you get tomorrow as well too, so you can just it's all linked there as well. And question was, can you talk about building a new home, new build home? So there's two different paths you can go down there. You can either do construction, where you're building it on your own, you're getting construction financing. We're actually working on a construction product ourselves with APM that we'll have available, which essentially you have to buy the land, and then you're having financing to build the property. You can also go down the path of buying from a local community or national production builder, where they're actually building the new home. And then, based upon the construction timeline of that, the new home build from a production or local community builder is probably the most commonplace. So how that would look is, if I enter a contract with a builder today and my house is going to be done in, let's say, December, then we would still go through all those 6 steps of home buying and then eventually have everything targeted to close when the home is done in December. Great question. It's okay. So the question was, some of the banks provide programs with less than 20% down payment and no PMI. Can you explain the eligibility criteria for such loans? It's a little bit of a misconception. I mean, some banks will provide no PMI, less than 20% loans, but if you guys kind of take a look back at the PMI screen, what you can do is you can buy out PMI through elevated interest rates or single premium payments. So a lot of times they're doing that by doing lender paid mortgage insurance, which are basically elevating the interest rate to buy out the mortgage insurance. So mortgage insurance is going to exist unless they're doing kind of a boutique product. But if you're doing a Fannie Mae or Freddie Mac product, the mortgage insurance is going to have to be paid for. It's just a question of how they facilitate that. And then if you start with one type of mortgage insurance like FHA, does the home need to stay in that type of loan for the duration of the loan? So I think we're kind of looking at more refinancing. So you can refinance at any time. And I think we should kind of comment on that, because you're going to hear more people talking about refinancing over the next several months. But refinancing essentially is where you're switching from one product to another. So let's say I owe $200,000 on an FHA loan, and now my home has gone up in value. And now I'm in the month of October 2024. I have a 7% interest rate, but I want to refinance down to a 5% interest rate because that'll help lower my payment. Well, I could refinance to a different product and help take advantage of a lower interest rate environment, therefore lowering my monthly payment. So you can switch products at any time. And those that purchased in 2023, a lot of our clients are probably going to start looking at refinance options fairly soon. And then question was, what are the pros and cons of a 40-year loan? Honestly, I don't really know who's doing 40-year loans out there. The longest term we offer is a 30-year loan. There's probably some boutique or niche products out there at 40-year loans. I think the pro would be, obviously you can stretch your payments and make it a little bit more affordable, so it's a lesser payment. The con is you're going to be paying for a longer period of time. Usually products like that are going to be kind of opportunities to get into home ownership at a lesser payment, but the trade-off is going to be a higher cost. Usually those loans are quite expensive. We just don't offer those kind of products. We want to make sure things are helpful for the buyers, but we also want to make sure they're cost effective too. Okay, great questions. You guys held up all your questions to the end. I love it. Any other questions from our group? I think I tackled most of them. Ken was helping me out with some ones in the chat too. Ken also put in some of the calculator items in the chat, so you guys have that. I did have a question here that I think might have got missed. 2 of them. What happens for small business owners for qualifying? So for small business owners, depending on how your tax structure is, we do need the last 2 years of taxes. So if you're a sole proprietor, it'll include your Schedule Cs. If you're, S Corp or C Corp, we'll need the last 2 years of business tax returns. So we will need to see 2 years tax filed. And then are brokerage funds considered acceptable sources for down payment? And the answer is yes. So you can certainly access those funds. So if you make a trade of, say, a stock, and you put it into a cash position and you want to use those funds for your home purchase, you can absolutely do that. We'll still need to verify the location of those funds. So we'll have to see kind of the paper trail of the sale of the asset and then the transfer into cash. All right. Good questions, everyone. Okay. I think we did it. I think we got to all of our questions. Of course, if we missed something, don't hesitate to reach out to us. And I do hopefully I get a chance to get connected with all of you to help you on this path towards homeownership. I appreciate everyone's time. I know everybody has busy schedules, especially on a Thursday. Appreciate y'all taking time out to learn a little bit more about home buying. And, you know, again, we hopefully get a chance to get connected with you in the future. All right. Have a wonderful evening. We'll talk to y'all soon. Good night.